What are junk bonds? And why do hedge funds invest in junk bonds? Let's understand this concept of why investors have a fancy for a junk bond, that is a bond that is already defaulted in its coupon payments, and what is the theme over here when investors want to invest in junk bonds. Hello everybody, I'm your learning partner Sushila Harihar, and if you're interested in a career in investment banking operations, trade life cycle, OTC derivatives and hedge fund accounting, do subscribe to my YouTube channel where we provide content-centric videos on these topics. At the very first instance, I would like to tell you what is a credit rating. Every bond that is issued by a company to the investors and is publicly traded by the markets must have a credit rating assigned to it. A credit rating is normally an alphabetic assignment of the different alphabets given by independent rating agencies such as S&P, that is Standard and Poor, or Moody's, or even Fitch in the United States market. In the Indian markets, it could be given by CRISIL or ICRA to the different bonds that are traded in the market. So the rating agencies conduct a thorough and a complete comprehensive financial analysis as well as a management evaluation and the need of the funds kind of a situation to analyze why the bonds are issued, and while doing so they then assign a rating to the bond. A rating given by an independent rating agency is mandatory for all public issuances of bonds because it demonstrates the ability and the willingness of the issuer to pay coupon on time to the investor as well as to repay back the principal on maturity. Over here, we must understand the concept of how credit ratings are assigned to different bonds. Some of the bonds could be rated AAA, which is the highest rating given by S&P to the top-notch companies and to very good quality bonds. This means that the issuer is definitely and is most likely going to be on time, on schedule to paying the coupon on the due dates as well as the principal on maturity. So how do they come to this conclusion? They come to this conclusion through a financial evaluation, through a management evaluation, through a project evaluation, and then building up the future financial cash flows. So over here, it is very important that the ratings are kept in mind by the investor before investing in different bonds. So as you can understand, AAA rating is the best rating that is assigned to good quality bonds, which are unlikely, it's not a guarantee, it is unlikely to default in the future. Okay, so these kind of ratings give a sense of comfort to the investor. If it's a risk averse investor, they would like to invest in a AAA kind of a rated bond. But because these bonds have a AAA rating, the coupon payments generally are lesser because the issuer is confident of making timely payments of coupon as well as returning back the principal on maturity. So over here, the case arises that if there is a likelihood of a default, so here the ratings is assigned on the basis of future cash flows. So if there's something that could go wrong, if the project doesn't go off on time, the ratings start declining from AAA to AA to A, BBB, BB, etc. So the investment grade bonds are the bonds that have AAA rating, AA rating, single A rating, BBB rating as well. And then come the speculative bonds. Speculative bonds are those bonds that have a degree of default assigned to them by the rating agency. Since they're not as good quality bonds as the AAA rated bonds, over here you must understand that the bonds will have some bit of a default risk attached to it, and therefore the bonds will pay a slightly higher coupon as compared to the investment grade bonds. But there are bonds that are already in default. They have already failed in their payments. They're already running behind their schedules for payment of coupon to the investors. And such bonds are called as junk bonds. In a junk bond, the bond is already having coupon payment pending, okay, and because of this junk status of it, the speculative nature of these bonds is very high. All right, the price is in fact much lower than the par value of the bond, and hedge funds with their very large risk appetite want to buy these junk bonds if the investment objective is turnaround strategies. Okay, in a turnaround strategy, hedge funds are looking to buy loss making companies or default bonds or junk bonds, so that with the help of additional capital, with the help of additional strategies, and a more streamlining of the expenses and the costs involved, it is expected that the bond will recover, the company will recover from its loss making situation to a profit making situation. So junk bonds are those that are already in default, and yet investors have an appetite in them because the yield on such bonds is really very high. Remember, when a bond has been downgraded, okay, then there is a large supply of these bonds in the market. As supply increases, the price of the bonds will fall because there is no demand at the initial stages of the re-rating of the downgrading of the bond. Then as the price corrects itself, we find that investors have started buying these bonds because they find that there is a possibility that the negative news is not so negative as was mentioned earlier or as was thought of earlier, and at the same time the probability of the company doing better or not becoming as bad as was implied by the price action is what spurs investors to start buying junk bonds. And so when investors start buying junk bonds, they believe that the company can have a turnaround story. The company can move from a loss making entity to a less loss making entity and then to a profit making entity. And when it makes these transitions from extensive loss to less loss to perhaps profit, then the price at which they have bought the bond, remember they bought the bond at a very low price because of the downgrading. Then when the company repays the bonds, then it will repay back at the par value. So the investors can make a significant amount of profits on the capital gains for the bond because they have bought the bond at a much lower price and they're going to be redeeming it at a higher price, provided if and only if the company is able to turn around and is able to move from less loss to from severe loss to less loss to profit. When it does that whole turnaround transition, and we have seen many of them do it, especially commodities which have moving in cycles, we've seen that happen. We understand that such kind of bonds are not just enough for the investors, but also very good for investors with large risk appetite, those who are willing to take the higher risk because they are able to see something about the future of the bond, of the future of the company, which looks promising to the investor as well. Hence, junk bonds are traded even now, even very aggressively by hedge funds and by funds which have a large appetite to take on such kind of riskiness.